lot of those, the trade that happens is essential things like semiconductors. And so, if you were to have, kind of a tail risk of really kind of bad breakdowns in terms of geopolitical relationships, that would certainly be inflationary. And also, even in a more gradual sense, the past 25 years, part of what's held down certain types of inflation is the globalization that we've done. And so I do think that there are a variety of tail risks related to geopolitics as well as internal politics. But pretty much the highest probability outcome is that this can take multiple forms, but that cash and bonds are unlikely to hold their purchasing power throughout most of this 2020s decade.
Are we in sort of a war today? How do we compare peacetime finance to World War II era finance?
Well, so far, it's kind of similar because, they're essentially using the pandemic as the external threat to be, fighting, as well as just it's one of those things where COVID is just one part of it. The real kind of issue there is you had such a highly leveraged system that when you had a supply chain disruption, it could have been anything. It could have been, a volcano goes up in a crazy place. You could have had, some other natural disaster. So anything kind of disrupts this really intricate, highly tuned global supply system with leverage that is hundreds of percent of global GDP. And so basically, it's, I think a good way to look at it is the long-term debt cycle, which is popularized by Ray Dalio. And so that's kind of the overall framework for why the 30s and the 40s looked the way they did, right? So you had specific factors like the Dust Bowl in the 1930s. You had obviously the war in the 1940s, but many of things were actually interrelated, right? So basically a lot of the conflict in the 1940s was because of a lot of the stagnation and populism of the 1930s. Obviously it expressed itself in different ways in different countries. If you look at that, kind of the framework of the long-term debt cycle, that's why we're seeing some of these echoes happen here, that it's not specifically the virus, it's not specifically, the financial crisis could have happened another year, but it's specifically the fact that so much leverage is built up in the system, first private debt, and now we're kind of moving on to the public debt portion, that has its own set of consequences. And the actual, the specific shape of that can take multiple forms based on policymaker decision, based on luck, on random events, but the overall kind of fragilities were already there.
On one hand, you have deflation, you have aging demographics, you have technology, you have offshoring, all these different levers that make things cheap and that basically can slow down growth and basically suppress wages and keep inflation at bay. On the other hand, we have, if you look at the types of inflation, there's a big difference between what, say, commodities have been doing, before last year compared to, say, healthcare costs. Healthcare costs in many countries, especially the United States, we actually have the highest healthcare costs in the world down here. There's just so many forces on either side. And that was, the case back, in the previous long-term debt cycle as well. So the previous time we had the ending of a long-term debt cycle was the 1930s, and then, it was bleeding into the 1940s, and they had a very similar environment there. So the 1930s were extremely disinflationary, and it was only because of this, massive policy response as well as, external factors that you got that more inflationary kind of rebound out of it. And so we're kind of seeing a similar thing now where the 2010s in many ways were very disinflationary. We had a period of commodity oversupply. So most commodities were cheap. That helped keep a lot of kind of basic pricing down. We had a lot of outsourcing. So, things like electronics and apparel kept getting cheaper and cheaper. And the real kind of worries were the services sector. So anything where you're paying someone to do something essentially.
Well, a lot of our supply chains in the United States are intertwined with China. The same is true for Europe and China. Singapore, for example, is a really big hotspot for global trade. We have a very interconnected world. There are some countries that are a little bit more isolated than others in terms of, say, trade as a percentage of their GDP. But a lot of those, the trade that happens is essential things like semiconductors. And so, if you were to have, kind of a tail risk of really kind of bad breakdowns in terms of geopolitical relationships, that would certainly be inflationary. And also, even in a more gradual sense, the past 25 years, part of what's held down certain types of inflation is the globalization that we've done. But things that we were able to outsource to cheaper markets, like electronics manufacturing, broad kind of cheap manufacturing, those prices have been very low. And so if we start to, we've kind of hit the end of that road, I think, in terms of how much we can do. I think there should be multiple kind of measures of inflation, and in some sense there are. I mean, that's why there's things like producer price indexes are useful. You can also just look at, what is the raw, commodity index doing? So what are commodity prices doing? That's one of the big factors of inflation. Generally, you don't have strong inflationary periods without commodity prices also going up a lot. But like I said, over the past decade, the problem is that, the big areas of spending that most people spend their money on have gone up faster than wages and have gone up faster than the official CPI. And so, whereas, on the other hand, your TV got cheaper, your computer got cheaper, but those are generally pretty small percentages of a household budget. And so some of those other, things are really important. Well, mainly what I'm watching is, kind of a lengthy period of persistently negative real rates. I think that's what policymakers are aiming for. They've even been pretty explicit about their intentions. And so, for example, if you look back for the past decade, T-bills spent most of their time with negative real returns. And, I think we're seeing that playing out again here in the 2020s to an even bigger degree, and including a lot of those longer duration types of bonds as well, where if you hold a 5-year or 10-year treasury, by the end of this decade, I think, you're going to have less purchasing power from that bond than when you originally bought it. And so I think that's kind of the biggest takeaway of this decade. Now, whether or not we get tsunamis, economic tsunamis, a lot of that partially depends on, individual countries' political situations. And so there are kind of these powder kegs around the world. I mean, Europe obviously has an issue. And so I do think that there are a variety of tail risks related to geopolitics as well as internal politics. But, pretty much the highest probability outcome is that this can take multiple forms, but that cash and bonds are unlikely to hold their purchasing power throughout most of this 2020s decade.
But going forward, especially as we saw over the past year, the major tools that the policymakers have to combat inflation can becoming, to combat deflation and create inflation can become increasingly aggressive as some of those other tools, basically fail to work. And so a lot of people thought, a decade ago that quantitative easing would be inflationary. That was kind of the narrative back then. But what we saw last time, as well as the previous time in history when that was done, is that basically increasing, the base money is not very inflationary, because, you're not necessarily increasing the broad money supply. You're not getting money into the hands of people. You're not having more money chase fewer goods. And so there's no real reason for it to be inflationary. At best, you could call it anti-deflationary in the sense that it prevents a bank collapse or things like that. But it doesn't really just result in what we generally think of as broad inflation.
Highly tuned global supply system with leverage that is hundreds of percent of global GDP.
All these different levers that make things cheap and that basically can slow down growth and basically suppress wages and keep inflation at bay.
But a lot of those, the trade that happens is essential things like semiconductors.
Is that basically increasing, the base money is not very inflationary.